Welcome to SilverOak's quarterly webinar. My name is Shannon King, and I am partner and president of SilverOak. And as usual, I have Jonathan Charlo, also a partner with SilverOak and our lead analyst. He's joining me today. And we actually have a special guest with us today, another partner of the firm, Kathy Nelson, who will be entering the discussion later in the webinar, and she'll have some great information to share with us about the new tax law changes. So before we actually look at that agenda, let me get some house cleaning items out of the way. First of all, today's webinar will take 60 minutes, and I think maybe even a few minutes longer. So we're trying to get it started a little bit early to get these house cleaning items out of the way. We've got a lot of information to cover. If you have any issues during the webinar with audio interference, I would recommend that you close down any other applications you might be running on your computer at the same time. That tends to help the audio if you have any interference issues. If you have questions from today's webinar, certainly feel free to contact your SilverOak advisor. If you're not working with a SilverOak advisor, you can contact me directly at 952-896-5701. And as usual with each of these quarterly webinars, I want to thank Jonathan and the rest of the team. It really takes everybody to get this information gathered and to get the webinar set up for presentation. So we got a great team, and I appreciate everybody's efforts in making this happen. Into today's webinar, we will not be discussing SilverOak portfolio performance specifically, since each of our clients' portfolios are customized. However, all of our clients should have received their customized performance reports by now, and we have already started reaching out to clients talking about any adjustments that might need to be made. For compliance purposes, the last thing I need to note is that we will be discussing the overall markets and economy during the call. And in doing so, we'll provide our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. Past performance is no guarantee of future success. So with that, let's look at the agenda. With each of these quarterly webinars, we try and touch on economic data that's come out since our last discussion, and then we'll talk about the impact that data had on the markets. For today, we're going to really consolidate those two discussions. We're going to keep the economic data to maybe 5, 6, 7 minutes at most. We'll review the market data pretty quickly as well, so you're going to see that those are much shorter in length than the typical webinar, and that's really to give us time to talk about the new tax law and to have Kathy's expertise in the discussion. So we're going to try and get through these early sections relatively quickly. With that, Jonathan, in 5 to 7 minutes, tell us what happened during the fourth quarter as it relates to the economy.
Well, actually, not a lot changed in the fourth quarter. And so, as you mentioned, we're going to condense what we're showing. But as usual, we'll start now with kind of the SilverOak market dashboard. And as I mentioned, not a lot has changed. And so when we look at our dashboard for this quarter relative to last quarter, it's unchanged. The economy, credit markets, and market sentiment are still very positive. Valuation is really the only factor that's not positive. And if anything, with the market advance, valuation has probably come up a bit.
Sure. Now there is comments though that valuation may be a little bit more justified if we get the earnings expected from the tax bill, right?
Absolutely, absolutely. Now here we've started showing this in the last couple of webinars, but the blue line is the S&P 500, and then the other two lines are the composite score from our dashboard, putting all of those indicators together. And we did see the indicator come down a little bit from the last quarter, but not meaningfully. And you'll see right in the middle, that line is really the line we've seen in the past, where below that, stocks versus bonds stocks just aren't as favorable or likely to outperform. So we're still in very positive territory. Now we'll spend a little bit time going over the current economic factors. We have not had any of the factors actually move from one column to another. So we'll kind of start on the positive side. One of the things that we did see dip a little bit this quarter was consumer confidence, but it's still at a very high level. Another factor that dipped a little bit this quarter as well is employment numbers. And what I caution there is that when the economy is so strong and we've really, we're 8 years into this recovery, it's getting harder and harder to add new jobs. Unemployment is falling, and so that's really not a huge negative factor, but it did come down. One thing that was very positive still in the quarter was the strength in corporate earnings. We continued to see very strong earnings reports and outlooks, and we'll actually go into that on a discrete slide. Within the neutral area, interest rates were a slightly negative factor. Now, they were up and down last year, but they have moved back up. And then, quite frankly, as we look into this year, the Federal Reserve will be raising rates.
And to that point, I saw an interesting statistic the other day that indicated that the economy typically dips into a recession 4 years after the Federal Reserve starts hiking rates. And the first rate hike in this cycle was in late 2015. So, anecdotally, that's maybe a little bit concerning. With that having been said,
the US dollar was positive in the sense that it came down, and that's good for exporters, manufacturers. It's also good for investors. As dollar denomination comes down, it helps your international returns. Global growth continues to be positive. We've seen things doing well in Asia, but probably most importantly, we've seen some particular strength coming out of Europe. Geopolitics, that is a little bit of a negative factor. There's still a lot of things going out there. There's North Korea. There are still wild card possibilities. And then, as I mentioned, the Eurozone is now in an upward trend, and it seems to be pretty stable.
So looking at all the factors and looking at our dashboard, again, the summary is not much has changed from last quarter. Maybe some of the factors are down a little bit overall, but not to a threshold that would cause great alarm.
Correct. Now, one thing we did break out is GDP. And what I'm saying is it was relatively strong in the fourth quarter. It just came out this morning, the first estimate, and it was 2.6%. That's pretty good, but the prior 2 quarters, we were seeing growth rates in the low threes. So this is definitely a relative disappointment, but it still is a pretty decent number. Now, one area that just continues to be strong is the leading economic indicators. It came out in the last week. It is actually very strong, seems to be strengthening. And if you actually look at that slope, in the last year, that slope has increased. And so it's been a very steady advance. And as I mentioned, earnings have been very strong. And so when you look at 2017, we did eclipse the old highs that we saw in 14. And so very strong Q3 numbers, up to $31.32 for the S&P 500 for the quarter. And really, when we look to this next year, there's actually some pretty high estimates coming out. Question will be whether we can meet those. Sure. But so far, we did have that same skepticism last year. They were met. And when you look at strong global growth, the dollar being down, there's a strong possibility that earnings will be as strong this year.
And another statistic that I heard that relates to the earnings is that, again, typically recessions, they start 2 years after earnings peak. So to your point, if we haven't yet seen the height of earnings, that's probably good news that maybe the recession isn't quite as close as some other indicators might point to.
Yeah, and we didn't really share this, but when we looked, certainly when we factor in the dashboard, we're not really seeing any early recession indicators as of yet.
Perfect. Well, with that, let's talk about the overall markets. So it's unfortunate that we have to go through some of this information so quickly today, because I could probably sit here and talk all day about the markets after a year like 2017. Obviously, good numbers as we look on this slide in the fourth quarter, but just exceptional numbers for the year. So it just so happens at a time in which we could probably, really spend a lot of time on all these positives. We're going to cut this discussion a little bit short to make up room for the tax discussion a little later on. But as everybody can see, numbers here just absolutely excellent. If you haven't been happy with performance the last year or so, frankly, you're probably never going to be happy with performance, because these numbers are well in excess of historical averages. As we look down this page, you'll see the bottom numbers are slightly higher than the top few numbers, and that's because those are the international markets. So the couple themes that we saw was international outperforming US. We'll see in a few minutes the growth outperformed value, and that was pretty much across the board. So as we transition, here we have the bond markets. Of course, equities outperform bonds, as they typically do through kind of full cycles. But nonetheless, even here, Jonathan, bonds performed quite well.
Surprisingly well, in the sense that you're in an upcycle and the Fed raising rates.
So as we look at this slide, I already commented on growth outperforming value, but it's really clear as you look at this in both the fourth quarter and the calendar year that that's indeed what happened. You'll also see here that large cap outperformed small cap. Now there is some thought that with the new tax bill, small caps may come back into favor because they get probably a bigger boost from the tax legislation than large caps. We haven't yet seen that, at least not prolonged, but we wouldn't be surprised if small caps didn't start to get a bit favored over large caps.
Here we're showing kind of the historical viewpoint of large cap performance versus small cap performance. This chart goes back to 1979 when Russell created the small cap index. And they created it because going back to the 1920s, there was a perceived small cap effect. And what we've seen really over this period is that small caps have slightly outperformed. If we look at it just over the last 20 years, small caps have outperformed in 13 years or 65% of the time. But when you really look at this cycle, small caps have only slightly outperformed large caps, and more recently, large caps have been outperforming.
Well, the one thing I like about this slide, though, is the fact that with one or two exceptions just for this limited time frame, it's pretty much happenstance, right? I mean, as soon as you think that there's some kind of series there, all of a sudden the outperformance flips. As an example, obviously in 2017, large caps outperformed small caps. In 2016, small caps outperformed. Then in 15, large caps outperformed, right? And they're flipping back and forth. So this is really an example of how you can't time which one's going to outperform, because it can literally flip in the course of just 6 months or so.
And we've talked a little bit about growth leading the way. You can't see it really in the quarterly returns, but when you look at in the blue at the yearly returns, you'll see at the bottom technology, clearly the top performing sector, and that has a large weighting within the growth space, roughly 40%. Now, looking at the value area, you'll see materials did pretty well, financials did pretty well. Financials only make up about a quarter of the value universe, and materials a very small percent. So really, because of the strength in technology, that's why growth outperformed. And here we're looking at the performance of growth versus value stocks through time. And you'll see that it flips, and there are a few little cycles that you can see, but there's also, especially more recently, more randomness to it. So it is hard to predict, so diversification does make sense. But what I will say, though, is that in the last few years, we have really seen some dominant growth years. And so that's caused this cycle since 2009 to be a growth cycle. But again, it can flip, and certainly, financials could do better going forward. There has been talk about technology beginning to become very overvalued. Maybe not approaching yet the 2000 sort of peak, but we're starting to see some of those things.
Well, let's talk about international markets, because so far we've really concentrated the discussion to the U.S. markets, and large caps most recently outperforming small caps, and growth most recently outperforming value. But I alluded to it earlier, where international actually is outperforming U.S. So what are we seeing in the international markets?
So when you look at the full 2017 year returns, you're seeing very strong returns across the board. On the left is really kind of the emerging market in BRIC countries. They did very, very well. China kind of led the way. Latin America was a little bit lower, but I think looking at the right side, that's where you can also see the strength, and we've talked about how the Eurozone is so strong. So you see France, Germany, and Spain, all very high returns. And that was something that we saw for the year. Now, in local currency terms, the returns were very strong, but again, because the US dollar was down in 2017, that also helped returns as a US investor. And here we're looking back over time at US versus international equities. And what I will say is during this long period of time, US has slightly outperformed international over time. But what we have really seen, if you look at the right side, is that the U.S. has really led the way in this cycle.
Yeah. Well, and here, what I see anyway, is that over the last several years, it was hard to convince investors to stay with international, because you can see there were 3 or 4 years there where U.S. stocks outperformed, and yet, keeping that diversified approach and maintaining that international exposure really did help in 2017. And frankly, now we're starting to see clients wanting to maybe overweight their international portfolios, and that might, international might continue to outperform for a period of time, but chasing those types of returns is difficult, because at some point, right, the U.S. is going to come back in favor. And timing which is in favor or will be in favor is just a very, very difficult thing to do. So let's talk about bonds, because you already alluded to the fact that it was kind of surprising bonds did as well as they did during this slightly rising interest rate environment.
Yeah, so the Fed did raise rates last year, but what we saw with the 10-year Treasury is that it had its ups and downs. But I think really what happened in the year was the strong global growth certainly helped the emerging market area. The strong growth helped the credit-oriented areas. So on the left side, you're seeing those very, very high returns. And if you look on the right side with the U.S. Treasury, with returns a little bit above 2%, a good bit of that is really the underlying yield. So as rates have come up, that yield has increased. And then you'll see municipals in the middle. They really were unjustifiably hit after the election, and so they've recovered a bit. Certainly there were some questions about the tax deductibility. Those questions have gone away, and they still remain very well positioned.
And when you say they were hit after the election unjustified, this was the Trump administration coming in back in late 2016. They got hit, so in 2017 they kind of recovered from that.
Absolutely, and part of that was this idea that with tax cuts, the deductibility of interest wouldn't be as valuable.
Sure, yeah. Now the same thing we saw in equities, with international equities outperforming U.S.-oriented equities, although both did well. We saw that in bonds also, with international bonds pretty significantly outperforming U.S. bonds. So having that little amount of international bond exposure in our clients' portfolios really did help the overall bond performance.
Absolutely. Now you'll see that for the prior 6 or 7 years, U.S. bonds did outperform, and essentially our rates were coming down, growth was good. But the other side to that too is that with that diversification is historically international bonds have had a higher yield. You get that diversification benefit with different interest rate policies among all the different countries.
Sure. Well, let's quickly go through our outlook. As it relates to the economy, I don't think really much has changed here from our discussion last quarter. Is there anything that you would want to point out with regards to the economy?
Yeah, we've talked about growth and earnings. One thing I would like to point out, though, is with the tax cuts, and if we do see an acceleration in growth, that could spur higher levels of inflation, and that could cause the Fed to be more aggressive in tightening next year. So that's one of the risks we might have.
Sure, sure. As it relates to the markets, where should we focus our attention, Jonathan?
Well, I think that we're going to see strong earnings growth, and so the markets can do well because of that earnings growth. But one of the things we have not seen since January of 2016 is any real volatility. And so that's a strong possibility that even though the markets could be up this year, we could have periods where they're down during the year.
Well, and I think we're going on either our longest or second longest period without a 5% correction in the market. And I think, I've told a lot of my clients, frankly, we don't even monitor 5-10% corrections because they happen so often. They don't even show up on our radar. Yet we haven't seen them for 12, 18 months. So people are probably going to be a little surprised when the next one comes along.
Absolutely.
On the fixed income side, I think you've already touched on the Fed, and they're likely to continue with their increasing interest rates in that cycle. Does that mean that bonds are bad and we should look at transitioning out of them, or how would you position the portfolio?
No, bonds really still have their position within a diversified portfolio. They provide that yield, but they also provide that stability if we do see higher equity volatility. A bad year for bonds might be down 2 to 3%, but other than a recession sort of bear market, there can be years where stocks are down 5% plus. So they offer that cushioning. And then the other side of that is with interest rates going up, your yield as an investor increases, and that is good in the long run.
That's a good point. And by the way, that 5% downside on equities, yeah, it could get a lot worse than that.
Right, in an actual bear market, absolutely.
Yeah, 2008, I think it was like 45%.
I just meant in the context if we had a normal pullback year.
Understood.
Which is possible.
Yeah, understood. So that's our update as it relates to the economy and the markets. Again, my apologies for going through that so quickly, but like Jonathan had pointed out, not really a lot had changed. And, I think probably everybody knows that the markets did quite well in 2017. SilverOak updates and New Year planning tips. Well, first of all, we are in the process of rebalancing our clients' portfolios. So if we haven't reached out to you yet, we will be reaching out to you regarding rebalancing. We do this quite regularly, but certainly at the beginning of every year after year-end distributions are posted. And we're continuing to convert to lower cost mutual fund share classes as well. We've had, I think in the last 12 months, the most conversions in a single period of time than we have in our history. As a matter of fact, probably the combined number that we've done the last 12 months is more than all of SilverOak's history. And there's a number of reasons why that's the case, but I want clients to know that we're always out there and looking for lower share classes, and as they become available, we're proactively transitioning into those. As far as New Year planning tips, a lot of these revolve around taxes. Remember the tax filing deadline normally is April 15th, but that falls on a Sunday. And then there's a special holiday in Washington, D.C. on the 16th, so the filing deadline's the 17th. With 2018 in the start of the new year, it's a great time to get your records in order. So if you're going through your 2017 documents and you're like, oh man, these things are a mess. Well, you got a new opportunity to clean things up for the 2018 tax year. Obviously, you review all your statements. Make sure you're maxing out on all of your contributions. I'm going to flip through these quite quickly, but again, these are all things that we're probably discussing with you already anyway. Review spending, Social Security statements, estate documents, beneficiary designations. Every one of these we probably talked to our clients about, if not annually, certainly within the last couple of years. So these are all things that we would continue to have you focus on. So with that, we are right on time to transition our discussion into the new tax law update. And in doing so, I'm going to bring Kathy Nelson in, and she's going to walk through a lot of these items with us. We don't expect to get through everything today. This was the biggest tax legislation probably since the Reagan administration. And so it would be too much, Kathy, to ask of you to do this in 35 minutes. But we are going to touch on some of the major components. We probably put too much on the slides, but that was intentional so that you could go back and look at the slides if you'd like. But we will definitely address, I guess, the bigger issues, right, that are impacting probably the majority of our clients. We're going to talk about those.
Absolutely.
Okay. So it says the Tax Cuts and Jobs Act. That always sounds so good.
It is good. Most of it's good. Some's good, some's bad.
Okay.
So the Tax Cut and Job Act was signed into law on December 22nd, 2017. So it's effective for individuals and corporations for tax years beginning after December 31st, 2017.
Okay.
It's interesting to note that even though the corporate tax rates are permanent, the individual tax rates are scheduled to sunset. So what does that mean? It means that when January 1st, 2026 comes along, we could be back under the 2017 tax rates.
But this is typical, right? This is what they did under the Bush tax cuts too. It's a little interesting they make the corporate ones permanent and the individual ones sunset, but you know, that's politics.
It is. We're hoping they'll be extended. So what we'll cover today, I'm going to spend most of our time highlighting significant changes to the individual income taxes, specifically the tax rates, the deductions, the credits, 529 account changes. We're going to briefly talk about estate and gift taxes, and if we get to it, corporate taxes and the new pass-through entity deduction. So let's start with individual tax rates. So the most significant benefit for individuals is simply the overall reduction in the tax rates. So this page is a comparison of tax rates for married taxpayers filing jointly. The rates and income brackets on the left side represent the 2017 tax rates, while the right reflects the new 2018 information. So you'll note the Act retained the 7 rates, but reduced tax rates at virtually every income level. In addition, the top rate was reduced from 39.6 down to 37%.
And to get to that rate, you need more income, from 470 in the prior years to now 600,000.
Absolutely.
So that's all good.
So across the board, our individual clients are going to benefit from these rate reductions.
Now you have here the standard deduction, which I know you're going to touch on. But that was doubled.
It was.
And probably the number of clients that are going to use it is doubling too.
That's correct, believe it or not.
So we'll get to that.
Exactly. So not everything changed. So if you're not familiar with the dreaded AMT, this is a separate tax system from the regular tax system. And it was originally designed to capture a small number of wealthy taxpayers. Unfortunately, as of today, I think 4.2 million taxpayers are
Wow.
subject to AMT,
Wow.
which is crazy. Typically, it affects taxpayers in income levels of about 200,000 to 500,000 that live in high tax states such as Minnesota. So the good news is, although the AMT tax was retained, the exemption amount has been increased. So it's going up from $86,200 to $109,400 for a married filer. More importantly, the phase out of this exemption now doesn't begin until you reach $1 million of income if you're married. Previously, that number was as low as $164,000.
Wow.
So what does this mean for people that have been in AMT historically? The good news is you probably won't be in the future.
That's great.
Other items, from a negative perspective, the net investment tax, which is the additional 3.8% tax that you're paying on your investment earnings, that was retained. In addition, the Medicare tax, the additional 0.9%, that was retained.
Mm-hmm.
So it's not all good news. On a positive note, the preferential tax rates for long-term capital gains and qualified dividends, they remained unchanged. So that's good. So what did change? First of all, the personal exemption, $4,050 that you generally took for yourself, your spouse, and your dependents, that's being eliminated. So, I mean, that's a big change for some taxpayers.
Which, for a lot of our clients, they were being phased out or phased down.
Exactly.
But, so it made it simpler.
Yep.
You don't have it.
Right, and you're correct. You know, if you were under the old law, if your income was in excess of about $435,000, you never received this benefit anyway.
Yeah.
So you already alluded to the standard deduction increasing. So again, it's almost doubling. It's going from $13,000 for a married filer to $24,000. And again, people originally think, why do I care? I've never claimed the standard deduction. Well, as we go through all the deductions that are being eliminated, you may be.
Mm-hmm.
So which deductions are we eliminating? Go back, you're right. Yeah. Let's start with state and local taxes. Probably the most controversial part of the tax plan is the limitation of the state and local tax deduction. Prior to the enactment, if a taxpayer wasn't subject to AMT, this deduction was virtually unlimited. Beginning in 2018 with the new tax legislation, it will be limited to a combined total of $10,000 a year.
So you take your state taxes and your property taxes.
Yep.
Put them together.
Yep.
And you get 10,000. Doesn't matter if it was 300,000 in total, you get 10,000.
Right.
That's a big change.
It is a big change.
So you may be getting to this, but just cut to the chase. A lot of people think, well, that my taxes therefore automatically are going to be higher in 2018 than in 2017. But we have to remember that the highest tax rate is now 37 versus 39.6, and to get there you need more money. So even though you're losing this deduction, which is usually a big one for a lot of folks, they're making up some of it with the lower tax rates. Fair?
Absolutely. I mean, I think we've been pleasantly surprised. We've kind of run this calculation for a lot of our clients. What did their tax situation look like under the 2017 tax rates versus the 2018 tax rates? And most of our clients were neutral or a little better, even losing the state tax deduction. Another change is interest deduction on your mortgage and home equity debt. So in the 2017 legislation, your mortgage, so your interest, is deductible on mortgage debt aggregating $1 million. In addition, you can take the interest deduction on your home equity debt up to $100,000. That's changing. Under the Tax Cut and Jobs Act, for mortgages entered after December 15, 2017, remember that date, the deduction is going to be limited to an aggregate mortgage amount of $750,000. In addition, the home equity debt interest deduction is being eliminated. So think about that. If you have a home equity debt in 2017, you'll be able to deduct it on your tax return, but in 2018, there won't be a deduction for this.
Interesting.
So I guess before we get off this, the one thing I just want to touch on is what happens if you have an existing mortgage that's $1 million today. So given it was entered before 12/15/2017, you're not subject to this limitation. You'll still be able to deduct your mortgage interest up to $1 million.
The old limit. But that's not true for home equity.
Correct.
So there's a grandfather of the mortgage, but not a grandfather of the home equity loan.
Absolutely.
Okay.
In the interest of time, I'm not really going to mention a lot of information on this slide because most of it hasn't changed substantially, but I am just going to mention that the miscellaneous itemized deduction subject to 2% is being eliminated. Now, most taxpayers didn't receive any benefit from
They
this
think they
deduction.
did.
No, I know. They didn't. It was phased out. They didn't get any benefit, so this really isn't going to have a lot of impact for most taxpayers.
All right.
Okay. So with all of those limitations, what can you expect to see as itemized deductions on your 2018 tax return? Well, you're probably going to have taxes, which you alluded to. It's going to be limited to $10,000. You might still have mortgage interest deduction, and you're probably going to have charitable contributions.
So as I've been talking with clients and looking at their situations, just to make it real practical, a lot of clients who don't have a mortgage, they'll have a $10,000 deduction for property and state income taxes combined.
Yeah.
There's a $24,000 standard deduction, at least married. So that means, at least in my simple way of thinking about it, that if you got a $10,000 deduction for itemized on state and taxes and property taxes, you have no mortgage interest. So really, you need $14,000 of charitable contribution deductions to get the itemized deductions above the standard.
That's correct.
Is that fair? Okay. We're probably going to talk about bunching. Is that coming up?
That's the next slide.
Oh, there you go. Perfect timing.
So what can you do? Shannon just touched on this a little bit. You should consider bunching your itemized deductions into 1 year and then alternate between itemizing and taking the standard deduction. So I'll walk through this chart just quickly because Shannon actually was highlighting a lot of the information. So we're assuming in the first two columns that somebody has state and local tax deduction of $10,000 a year. They have no mortgage interest, and they have a favorite charity that every year they give $15,000 to. So if you look at that and you add up, their itemized deductions are just over the standard deduction threshold. So
each year.
Each year, $25,000. So if they continued with this strategy over this 2-year period, they would have an aggregate $50,000 itemized deduction. Okay. If instead you flip to the right side, you bunch your charitable contributions into the first year, your itemized deductions for year 2018 just became $40,000. The next year, you don't itemize, you take the standard deduction of $24,000. So in that 2 period, bunching gets you a $64,000 deduction. So, I mean, $14,000 more of tax deductions or about $5,000 of tax savings.
But somebody might say, great. However, you know, the church or the synagogue or United Way or whoever it is wants their money every year.
Right.
And you're telling me to give them $40,000 in this example in 2018. What do I tell them when they come knocking on the door in 2019? So how do we address that?
Well, that's a great question. Well, I mean, there's a couple ways you can address it. I mean, one, you could use a donor advised fund. So, I mean,
I like that answer.
Yeah, I figured you would. So, I mean, you can front load your charitable contributions into a donor advised fund. You get the deduction in 2018, but you can distribute it to the charity in 2018, half of it, and half of it in 2019. So from the charity's perspective, they don't see anything different.
So donor advised fund, just spend 1 second on this, because we've opened more donor advised funds in the last 2 months than probably the last 2 years combined.
Mhm.
A donor advised fund is what? It's like a 401k for charity.
Exactly.
You put the money in. When you put the money in, you get the deduction. The money sets in this account. You can open it at Schwab or Fidelity, or everybody's got a donor advised fund. You can invest it aggressively or conservatively, kind of like a 401k. They each have their own selection of investments, and you get to choose if it's aggressive or conservative. And at any point in the future, you, the person that donated the money into it, decides which charity, how much to each of those charities, when it goes, etc. And you can put successor owner, so that if you passed away, you could have your wife or husband kind of become the owner, or even your children. I love these because I have a lot of clients use them like foundations, but you don't need $1 million or several $1 million to open them up like you do a foundation. You could literally open these up with $1,000 or $2,000.
Right, absolutely.
Perfect. Okay. So again, I love the bunching idea, Kathy. And then if you want to smooth out the contributions that the ultimate charity receives, you can do it using that donor advised fund structure.
So other options for you. So you can consider donating all or part of your RMD directly to a charity. So this strategy is a little bit limited in application, as it can only be used by taxpayers over 70 and a half. They have an individual retirement account and they're charitably inclined. So the benefit is, rather than taking the cash from your RMD and then writing checks to the charity, you just directly pay the charity from your IRA.
So you said limited, so you have to be 70 and a half. You can't donate more than $100,000.
Yep.
There has been some coordination that goes along with this, although I just found out within the last few weeks that we can actually have checks issued on the IRA account. So rather than going through a lot of paperwork and rigmarole trying to get the donation right from the IRA to the charity, which has in the past taken some effort, we can have check writing set up on these IRA accounts. Now, we want to be very careful, right?
Mm-hmm.
Because you're writing a check out of the IRA. Every distribution out of the IRA is typically taxable, unless you make that check out directly to a charity, and then you'll get the charitable deduction. But you have to be 70 and a half. You can't do it when you're 70 or 69 or 68. So we want to be careful. And I know Schwab Institutional, who we typically use as a custodian, also limits the number of checks that can be written in any single month to 5. So you wouldn't want to be writing 10 checks of $5 each to Girl Scouts and everything else. Great idea, though. The other thing, did you mention the Medicare?
Yeah, I was going to mention Medicare. So, I mean, again, your Medicare premiums are based on your taxable income. So if you use this strategy, this RMD is not reported on your taxable income. So it can help reduce your Medicare Part B and D premium. So again, it's just another added benefit. So we discussed a number of deductions that have been reduced or eliminated. We'll review some benefits that have been added or enhanced. The first is the doubling of the child tax credit. Although this credit's been in existence for years, it's a benefit that I really haven't seen a lot in practice. Mm-hmm. And the reason is, if you look down at the credit phase out, historically these credits began to phase out at really modest income levels. I mean, $110,000 for a married couple. Mm-hmm. Under the new law, the credit is increased to $2,000, and it's for children under age 17. And more importantly, it doesn't begin to be phased out until your income for a married couple is $400,000.
Wow, that's a lot more.
Mm-hmm. So, I mean, this is a credit I think we're going to see a lot, and it helps offset the loss in the exemption.
Mm-hmm. Good point.
In addition, there's a new tax credit. It's a $500 non-refundable credit, and it's called the non-child dependent credit. Now, this credit is a bit of a misnomer, as it appears to indicate that it doesn't apply to your children, but it does.
Only the IRS.
I know. It applies to your children who are over age 16 of age. So think about it. We just talked about the previous credit was for children 16 years of age and under. It's $2,000. This is your dependent children that are over that age.
I thought children were all the way up to age 26. Isn't that for medical?
Hopefully they're done at age 26.
Oh, okay.
Yeah. So again, a new credit, $500. I think it's something we'll see a lot because it has the same phase out, so $400,000.
Oh, that's great.
Yeah. Other changes we should touch on. So there is a change to the taxation of alimony going forward. So under previous tax law, the spouse making the alimony payments can deduct these payments on their tax return. And the spouse that receives the payments reflects it as income on their tax return. So, I mean, that's been the laws for as long as I can remember. Under the new law, the deduction by the payer spouse is now eliminated, and the payment is not considered income to the recipient spouse. So a big.
So just flipping it.
Huh?
It's kind of flipping it.
Kind of, yeah.
Yeah.
Absolutely.
Interesting. But this doesn't impact any divorce that was finalized pre
12/31/18.
Oh, 12/31/18.
Mhm.
Okay, so they're going to give them this year to settle whatever they haven't settled.
Yep.
Oh, interesting.
And it is interesting. I mean, this could cause some issues going forward as you look at trying to settle divorces, and you're wondering if we're going to have extenders, because you could be dealing with a situation where you have a non-deduction for the next 7 years, and then it would flip and be deductible again.
But anybody that has one in place prior to 12/31, person paying it deducts it, person receiving it claims it.
Absolutely.
Yep.
No change.
Okay.
529 accounts. We love these accounts. These are tax advantage plans designed to encourage savings for college. Parents generally gift money into these accounts. The funds are invested. They grow tax-free. If you take the money out for qualified educational expenses, they come out tax-free. So, I mean, they're a great savings vehicle.
We have a lot of grandparents even that use these.
Absolutely.
Yep.
Beginning in 2008, the Act permits a tax-free distribution of up to $10,000 to fund tuition at elementary and secondary public or private schools. So this is new. You could actually take $10,000 out of your 529 plan and pay for, your private school education in high school.
So more people, I'm just thinking of the implications of this. One, more people might start using the 529s, and they might fund them with more money than they did in the past. Because the concern was you don't want to overfund them for college expenses that you really don't know how much those college expenses are going to be.
Right. We're going to talk quickly about estate and gift taxes. So a couple changes to mention. The annual gift tax exclusion is increasing from $14,000 to $15,000 this year. That means you can gift anybody $15,000 and it's not considered a taxable gift. For a married couple, that's $30,000. In addition, the federal gift and estate exemption has doubled. And again, we had chatted a little bit about this before the meeting. We think this number, inflation adjusted, is about 11.2 million for single and 22.4 million for a married couple. So what this means is, for federal purposes, an individual can gift during life or death a cumulative $11 million or $22 million if.
And you say we think it's about that because they haven't issued the final number.
Right.
But
it's an inflation adjusted numbers, and we haven't seen that yet.
Okay.
But it's going to be close to that.
Right. Okay.
The only caveat to mention is that if you're a Minnesota resident, Minnesota's estate and gift tax exemption remained unchanged by this federal law. So it's currently only 2.4 million, increasing to 3 million in 2020.
And that's a big deal because we're one of few. I think there's 5 or 6 states that still have their own decoupled estate tax that definitely needs to it needs to be factored in when you're looking at your estate documents. Because I think you may even mention this later in the slides about the funding up to federal limits, and that can be a problem, especially when the exemption just basically doubled.
Absolutely.
Okay. Oh, here it is.
Yeah.
The review. Perfect timing.
So what impact could these have? What should you be doing? So first of all, you might want to review the terms of your will and your revocable trusts. You know, Shannon just mentioned you may have a formula that distributes a portion of your property that can pass free of federal. Oh, sorry.
Yeah. Well, pass free of federal estate tax.
Yep.
Up to the total, right?
22 million.
Right. And it may not allow disclaimers or any adjustments between 0 and 22.
Right. Absolutely. Or maybe you were charitably inclined, and originally this was set up at 5.6 million. So you were going to give your kids 5.6 million, and then the balance was going to charity. Well, if it's tied to the exemption, you just gave everything to your kids and maybe nothing to charity, which might be fine.
Kids will be happy.
Yeah. Again, might be fine, but it's probably just a good time to look at your estate documents and make sure that they're appropriate.
Yeah. Well, and it's not just looking at the estate documents too. It's also looking at your beneficiary designations, because all of this ties in together. And you might look at your documents and think, oh, everything looks fine even with this change, not realizing that some of the planning was actually done outside these documents using your beneficiary designation. So
that's
so
a
that
great
would
point.
be something to look at. Now you say this reverts back to 5 million. This is part of the sunset. Ouch.
I know. And so really, as part of the act, Treasury is supposed to come out with regulations that address what happens if you gift $11 million away during lifetime.
Yes.
And then you die when the exemption, it goes back to 5 million. So again, we don't know that it'll go back to 5 million, but if it did,
right.
you know, that might cause.
I would suspect they'll do what they did in 2010, right? That in 2010, the estate tax was completely eliminated, and then it came back in 2011.
Right.
They didn't make those 2010 estates pay taxes, right?
Exactly.
You got the benefit of the doubt. So
that's what we're
hopefully they'll be
anticipating.
fair.
Right.
Yeah. Okay. All right. Corporate taxes.
Corporate taxes. So I'm not going to spend much time discussing corporate tax changes, other than to highlight that the corporate tax was reduced from a top rate of 35% to a flat 21%. So this is the largest tax reduction in the corporate rate ever.
Wow.
Yeah.
And we're seeing the impact of it by all these announcements of companies bringing money back into the states, because there was a provision of this on the repatriation of dollars overseas.
Correct.
And so companies like Apple obviously is the big one that's announced big corporate headquarters, this, third, I think, corporate headquarters that they're going to build, et cetera, et cetera.
And which was the overall goal of this? This was to stimulate the economy. They wanted companies to invest in the U.S., create jobs, and stimulate the economy.
As a skeptic, or if you want to take the devil's advocate side, I guess you could say, yeah, they're going to bring the money back and they're just going to use it to buy their own stock and pay dividends or whatever, and they're not really going to invest it. Who knows? Even the argument that they're going to buy their own stock, though, if somebody's buying stock, that means stock's going up. And so there could be a broad-based benefit, because everybody's got 401k plans, they're invested in stocks, they may benefit from that.
Right.
So
kind of yet to be seen.
Yes.
So before we jump off this slide, I just want to make a comment. So unlike individuals, though, corporate AMT tax was repealed.
They get everything.
I know. So
permanent, and that's repealed.
Permanent. So there's no AMT tax for corporations. So when you look at this, the problem with the new tax legislation is that most U.S. businesses, they're not corporations. So they don't benefit from this corporate tax reduction or the elimination of AMT. So if you look at how businesses are structured, most in the U.S. are pass-through entities, meaning they're partnerships, they're LLCs, they're sole proprietors, or S corporations. And the income from these entities is reported on individual income tax returns. So if you recall, when we were going over the individual income tax cuts, they're nowhere near the size of these cuts. and AMT was retained.
Mm-hmm.
So the issue was, Congress was trying to resolve the discrepancy between the C Corp and the pass-through rates. And to do so, they created a new deduction. So we can flip over to that. It's called the Qualified Business Income Tax Deduction. I have to say, we're going to stay really high level. When I was researching this legislation, I ran across a picture of House Speaker Ryan speaking to the Heritage Group, and he was holding up the postcard saying, everything was going to be simplified, and you'd be filing your return on this postcard. And I can say with 100% certainty, this provision was not simplified, and there's no way it's computed on a postcard. So we're going to stay high level, and we'll start with the basics. So this deduction applies to all pass-through entities. It doesn't matter what kind of business you are, it's all pass-through entities. And it's equal to about 20% of your income reported from the business. So This deduction, if you had a $100,000 S corporation, it's making $100,000, you would get about a $20,000 deduction, assuming your taxable income is below these thresholds.
Your personal taxable income.
Your personal. So, that's a different measurement. This includes your interest, your dividends, capital gains, your spouse's salary.
So one partner in a partnership, one partner could get this and another partner not because of their personal income.
Absolutely.
Yes.
Yep. So if you're below these thresholds, everybody gets this deduction.
Yep.
Okay. Sounds easy, right? So what if your taxable income is above this limit? Then it depends on what type of business you are, which sounds a little crazy, but that's how it works. So for now, assume you're not a specified service business, which we'll talk about in a second. So you're a manufacturing company, per se. If you're above this threshold of $350,000 for a married filing joint or $157,000, you still calculate the credit the same, 20% of your business's income, but then it might be limited by the greater of the next two calculations, which is 50% of your W-2 wages or 25% of your W-2 wages plus 2.5% of your equipment, basically your business property. So what they're trying to do is they're really trying to incentivize companies that hire people and that buy equipment. So again, if you're not doing those, your credit might be reduced. Okay, so the question is then, what's a specified service business? Any business involved in the performance of services. So this is doctors, lawyers, accountants, actuaries, consultants. It's almost every single service business except engineering and architectural. Better lobby.
Why?
I think, again, the whole purpose is we're trying to build infrastructure. And probably the belief that if you're in engineering or architectural, you're involved in those industries.
Sure. Okay.
So the question becomes then, I am a specified service business, I'm an accountant, a lawyer, or a doctor, and my income's above that threshold. It gets complicated, and we're not going to spend a lot of time on this, but basically you're only going to get a pro rata piece of that 20%. Okay. So as your income goes up, that 20% deduction gets reduced proportionally.
To zero?
To zero.
Yep.
So going to the next page, what happens if you're a qualified service business and you're over $415,000? You're disqualified. You get zero deduction. So again, this provision is for manufacturing, wholesale distribution. It is not for service businesses.
Okay. We can see who's got the best lobbyist out there.
Exactly. The other thing that's important to note about this deduction is though it reduces your federal income taxes. So it reduces the federal tax you pay. It's not going to reduce self-employment tax. And it's also not reducing your alternative minimum tax. So this is going to be an add back.
Oh,
So that's kind of
so that could
bummer.
throw more people into it.
Absolutely.
Ah,
I'm interested to see how this turns
little
out.
gotcha there.
Yeah.
Huh. Interesting. Wow, that was a great summary. And I appreciate everybody staying connected, and certainly appreciate your involvement in today's webinar. If you have any questions, like I said, feel free to reach out to your SilverOak advisor. If you're not working with an advisor, you can contact me directly at 952-896-5701. I again want to thank Kathy for participating in today's session and putting together the tax materials, and for Jonathan and the rest of the team on the economic and market data. I hope everybody has a great day and look forward to speaking with you next quarter. Thank you.